Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. We've had great feedback on the launch of our podcast show, which is gratifying for me and makes the effort worthwhile. With more and more countries in lockdown, we've also found another way to reach our subscribers, a Slack chat room for all of our members. I'm a fan of Slack as a messaging platform, and we use it internally at Macro Hive. Now we're using Slack to reach you all in order for us to exchange macro and market ideas. Most members should have gotten an invite by now. If you haven't, then drop me a message. And in case you're not a subscriber yet, you can easily sign up to macrohive.com. Your first month is free, and then it's the cost of 2 or 3 cappuccinos a week. With the lockdown, you're not buying any cappuccinos anyway, so you should have some spare change to support Macro Hive. And remember, we're not a big company, so there's no government bailout for us. On to the research side, markets have certainly bounced this week, yet the news on COVID continues to be negative. We've expanded our COVID tracker now to include individual US states, which shows that New York has overtaken Italy in terms of per capita infections, and smaller states like Louisiana are seeing accelerating cases too. This tracker is super popular, so make sure to have a look at it. I've also looked at how Trump's approval ratings are doing through this COVID period, and the answer is clear. He's never had a higher approval rating than this. We had a great piece by regular Dominique Dwarf-Rocco, who laid out how Western countries could use clever testing and contact tracing to minimize the economic fallout. We also looked at fiscal policy across multiple countries, especially some of the smaller ones that are less well covered elsewhere. For the economic geeks out there, we reviewed some academic work on DSGE models, which for the uninitiated are the economic workhorses for central banks. I wonder how those models are coping with COVID. Now, onto my conversation. In this episode, I'll be talking to one of our occasional writers, the Macro Dilettante. Due to his work and other commitments, he prefers not to disclose his name, but I've known him for many, many years, and he is an iconoclast and one of the most original thinkers in the macro space. Back in January, he was the first person to warn me about the global consequences of COVID, and I mistakenly didn't heed his advice until much later. In terms of his background, he started work as a physicist and then has worked in financial markets since 1988. He's generally focused on fixed income and foreign exchange. In terms of the roles he's had over the years, it's included being the head of global foreign exchange at an asset manager, the head of Euro liquidity at a UK bank, portfolio manager at several alternative asset managers, and most recently as head of markets and the investment director responsible for fixed income at a UK pension fund. We had a long conversation, which I've had to edit down, and we'll jump straight into the heart of the conversation.
We have a real problem here because we only ever talk about price and we never talk about time. Bilal, we never talk about time. And I've been saying this for a while, as you know, is that this isn't about price. It's about the astonishing rate of change. The virus has imposed rates of change that are not normal in the market. See, even if you're an algo trader and you're talking about milliseconds, you might be trading in milliseconds today and tomorrow and the next day, but you're not talking, 2 weeks later about microseconds and 3 weeks later about picoseconds and 10 weeks later about femtoseconds. Your time frame is stable and you act according to that time frame. So what do we have? We have stable policy time frames, stable political time frames. We have stable investment timeframes because most people review monthly or quarterly or maybe even annually. And then against which you have to superimpose the exponential growth timeframe of something that's growing so quickly and so rapidly that we simply have no way of matching up our normal timeframes with it. And I think that is part of the reason why this has become so destabilizing. And the other time frame is that's the rate of change problem. And the other problem is we don't even know the maturity of the problem that we have. Where are we now? Are we at the beginning? Are we at the middle? Or are we near the end? And if we're not near the end, how long? And if we are near the end, how long? So we don't know almost any aspect of time. And that makes it very difficult to compound interest. It makes it very difficult to work out relative to default probabilities. And when you add to that the other component, which is cash flow, well, we don't know when we're going to get cash flow. We don't know when we're not going to get it. We don't know whether we can afford to believe, whatever deal has been sort of dreamt up by the Fed or the regulators or the central banks or governments. We don't know how can we tell how much is needed if we don't know how long it's going to last? So those are so existential.
That's a good point around time. So one is that we're exposed to an event which has an unstable rate of change, exponential, has S-curve dynamics and so on. At the same time, we don't know the endpoint. So that's another time sort of horizon that we're not sure about. But then when it comes to, say, the policy side, we've had recent announcements by the Fed and the ECB, and you could almost say by governments in relation to fiscal, where they're kind of almost saying that, look, we'll do whatever it takes to absorb the shock. So in that way, they're almost saying, look, we'll be elastic. We'll kind of absorb whatever that uncertainty is. We'll basically take it on. I mean, is that something that can impose some structure around time?
Yeah, they're prepared to play. They're almost prepared to say, we're prepared to play the virus at its own game. We will always be able to escalate. Yeah. Always. Well, there's no money we cannot spend. And that is what is pretty good about the response. Yeah. Now, the problem is that there are these other components to where we end up, which is the things that we don't really have very much choice about, which is things like implementation. Now, it may well be so all the governments have said they're going to do this. The Fed has certain things that it's got in play, so the ECB, the Bank of England, everybody's done that. But really, it's really, really important that the implementation of these strategies, or actually their tactics, really, they're not really strategies, are they? Because, they're tactics. It's really important that those tactics are implemented quickly, because I think we also have a shortening period of time of which people are prepared to actually show confidence in the system. The rate of change of this thing, everybody knows how rate of change it is, right? Everybody sort of knows now. I think everybody, more than ever before, people have probably looked the value of E up. Or they've probably seen a graph with an exponential. Oh, that looks a little alarming.
Yeah, I think we've all Googled exponential curves, log functions, and all the rest of that, stuff now. Yeah,
that's true. Now, but against which it's how long will the market remain sanguine, and that is because if you think about it, it's very easy to remember because these time frames are so quick. When did the market actually start to fall? Well, let's not conflate the two things. The market was already falling in late February, right? So on the one hand, it ignored what was going on in Wuhan for almost a month. I would say it ignored. I think it was pretty clear something bad was happening in mid to late January. It ignored that for a month for its usual reasons of prices, everything, and momentum is going up. So the market, the recognition is, the market knows everything. The market knows more than we'll ever know. It's going up, ergo there isn't a problem. Now, I can't even remember why the market turned.
Yeah, I think it was when the virus spread to Korea, when I think around that time, as soon as it sort of jumped to Korea and Korea started to have a big increase in cases, then I think the market suddenly said, hang on, this is not just a China issue.
So exactly that. So say some sort of general recognition that not everything's perfect, but actually we had to wait until, I think it was it March the 11th when WHO
where they
announced
designated
the pandemic,
it as a pandemic,
right.
Yes.
But Bilal, that was 2 weeks ago. That's just 2 weeks. That's what I'm saying about the rate of change. When the pandemic was named, what had to happen at that point was it was no longer good enough for anybody to not have a policy. You then had to have a policy. Central banks had to react. Governments had to react. They couldn't just go, well, what's going on over there? It looks a little bit, it looks a bit fruity, and and all the markets will do what they like. There's a bit more risk. But after that, that's when everything started to change. It was literally on that day. And that's only 2 weeks ago. So, here we are having this conversation. We are massive hostages to fortune. We have to laugh about it, really. We can't really say anything about. We can talk about the market environment that has led up to this, and that's a little boring because we all know what it was. It's the market of one, cross correlations in every asset class being incredibly stable, volatility being on the lows, credit being on the tights, equity markets making all-time highs, all that good stuff. That's what the market. That's what the market looks like at the highs. It doesn't look sexy and difficult at the highs, and no one ever rings the bell, as they say, right? So, and then what we've seen now is it turns out that actually the market was so interconnected in ways that even people who said that they knew about it, goons like me, claiming to see the plumbing was a little bit dangerously crook. And looking at the repo, what was going on in the repo market in the States, and saying this is a signal of something much more fundamental. Even folks like me, unbelievably surprised about how quickly this has changed, and it's really difficult to see what might happen next. If you were to tell me 2 weeks, I couldn't tell you that my view in the next 2 weeks is any better than my view over the next 2 years. I mean, all time frames seem equally as likely. Obviously they are likely, they're going to happen, but in terms of outcomes, I can't weight it, and I can't tell you whether the Fed will do another package. I can't tell you whether the House will need to do another $2 trillion. I can't tell you whether we're all going to start getting paid directly into our bank accounts, or that there's going to be another, that Japan's going to blow up, or Germany, or Brazil, or Mexico. I can't tell you. So on what basis can anybody make any sensible, cogent decisions about the excess risk that they're taking, Bilal? Can you tell me how they can come to any conclusions?
Yeah, no, that's a good point. And I think the irony is, when I speak to lots of investors today, because we've had some stabilization in markets over the past week, many of them are saying, in effect, where's the value trade? I want to put risk on now. We've kind of passed the worst of the storm. We've got the fiscal thing in place. The numbers in Italy, the virus numbers seem to be stabilizing now. We now kind of understand how this virus works, and I just want to get back into buying equities or risk. On the one hand, we've had such an extreme market move. You would have thought that it would have traumatized everybody. Yet the way people are behaving right now doesn't tell me that people are traumatized.
So I'm looking at this market here, and I'm not trying to make any judgments on price or value, because I don't know anything. We just don't know enough. We don't have enough data. We don't know how much people are being tested. We don't know many of the characteristics of the epidemiology. That's the problem. I think we know quite a lot about symptoms and what happens, but we certainly can't say very much about death rates, because we don't know how many people are being tested. We don't know whether they're dying or being misclassified. All sorts of things we just don't know. So, but imagine, look, we've just moved down 35%, whatever it was. I think we almost got to 37, something like that. So that's, and we've stopped and we've rallied, and that's great, and that's normal. I think they call that market, reflexivity. That's what markets do. They rally really sharply in a bear market, and they fall really sharply in bull markets. So say we got down to that old low again, and all these deals are in place, and all this stuff that's supposed to put a brake on paranoia and stuff. But the market, for whatever reason, has its reasons to go down there again. What happens if we lose another 35%? Well, last time I did this calculation. I couldn't help myself, and it's dangerous to do this, but just to give myself an idea of scale, and that takes us down 35%, and then another 35% if we're scaled up right. Well, that takes us down to 1,500. Now, I don't care what that means in terms of price, earnings, because I don't think price will be the factor. I think it'll all be about people being forced into decisions that they have no choice about. And the principal driver will almost certainly be the pension funds. remember, pension funds have very long-term timeframes, and one of the things that you'd always hope that your pension fund could do, and you'd really hope that it could, was to be counter-cyclical, as in, they were always able to buy the market on the lows because they've got a longer time frame. The problem with that is that when rates, and if we could come back to real rates, I think that's one of the reasons why all this has happened. When real rates are so low, it's very difficult for pensions to sit with very much deployment capital. And by that, I'm talking about cash. So in order for them to buy the market as it goes down 60%, they've got to have cash to spend. And now you go, well, surely they've got bonds. Well, the problem is, because interest rates are so low and real interest rates are so low, many pension funds, probably most, have a very high component of illiquid versus liquid assets. And that might be direct lending, for instance. Now, okay, direct lending is a sort of fixed income, but it's not cash. And the very things that drive the equity market down are driving direct lending wider and credit wider. So the very idea that you have this sort of available pool of deployment cash that you can apply on the lows, most people have not been able to build up those balances because they were stopping returns. Pension funds are huge. I mean, they're absolutely huge.
Pension funds are in some ways the ultimate end investor, I suppose. And I guess you rightly do point out, insurance companies, I guess, as well. In an environment where real rates are low, then that has effectively pushed out a potential counter-cyclical stabilizing force in the market. And who's pushed them out? It's the central bank that in effect has pushed the whole market one way, I suppose. And that's probably part of the liquidity problem we have in markets.
Yes. And look, I don't think there are very many people or very many participants who weren't doing a great job within their constraints of their mandate and within the constraints of what was going on in the market and conditions as they were. But what they weren't doing, there was no attempt to build in or to accept underperformance in their investments because they might need that insurance. Everybody said, well, if I want insurance, I can just buy an option, but I'm not going to. But what they should have done is they should have said, well, I need insurance. I'm not buying an option. I'm going to own cash because cash looks exactly like an option. It's a little bit expensive to hold relative to my performance. It gives me coverage if I need to do something at prices that I didn't anticipate. And it gives me freedom with my risk. It enables me to look at risk in a different way. I don't need to weird out. How many pension funds would have been sitting on 10% cash, Bilal? How many? How many?
Yeah, I doubt any, really. Yeah.
Right.
Yeah.
And then how many pension funds would have been sitting on 10 or 15% government bonds? No. I think very, very rare. They'll have mostly been sitting on some form of credit, probably superior credit. I mean, to their benefit, they'll have been careful, but not. It would appear not careful enough because this was not anticipatable. So what happens then when we get down 40, down 50%, and pension funds have to work out what their funding ratio is? Now, we would all hope that our pension funds, your pension fund and mine, would be in a position to say, well, I can play the long game and I will invest because I know that, this too will pass. Now, we'd hope that. The problem is there is a moment, I think it's got a name in markets, and it's called the Minsky moment, where the risk of recovery and the risk of ruin are around the same. And it becomes suddenly really important that you stop things getting worse because you need to exist. And I think if we were to see the long end of the market move another 50 basis points lower, not only 50, not 100, not negative yields in the US. I think we've already got there. Didn't we almost get to 30, 40 basis points in the 10-year note? So that wasn't happening because people thought that deflation was happening, obviously. That was happening because people were massive forced buyers of bonds, exactly when they were forced sellers of equities. And I think that's still on the cards. The problem for pension funds at this point in time is that their liabilities have exploded because annuities have collapsed, annuity rates have collapsed, and their asset values have collapsed.
Yeah, in terms of the liabilities, presumably this would only affect defined benefit pensions, not DC pensions.
No, you're absolutely right. And that's exactly right. But defined benefit schemes have got another characteristic. They tend to be public. They tend to be public. There are some corporate ones. They tend to be public ones. So I always think there's this sort of really peculiar. There's this peculiar socialization aspect to defined benefit schemes when they're public ones, which is to what extent, I think we know this, we know what the answer to that is, to what extent do you think the public will be happy to make good public pension schemes when they've lost all of their money in their defined contribution schemes? So what that means about pensions, this is what that means about pensions and how it relates to the current set of circumstances, is that pensions are already in a difficult situation going into this exact period. It means that they will, by definition, have been in some of the more fruity elements of risk because they just had to be. They couldn't reduce the discount rate because they couldn't ask people to make larger contributions, if you see what I mean. So in order for that to be okay, that means that they need to have a bigger allocation in instruments making significant real yields. And the only things that have been able to that allegedly make these real yields over time have been relatively illiquid, really not the greatest credits in the world. So that's what's so important about what's going on at the moment is that the global pension scheme, certainly the DB pension system, was already in a difficult situation, and this has definitely made everything worse. And now we have 10-year notes. Last time I looked, you know what? God knows where this will be in the next 2 weeks. But last time I looked, I think the 10-year note was around 85 basis points, 0.85. Now, what's okay? Maybe we don't have any inflation anymore, though I think we still do. So what are tips yields? What's inflation? That's definitely a negative yield, isn't it? So it's definitely a negative yield. So you go, okay, well, if they've got those bonds, why don't they sell those bonds and then put the spare money into equities? Yeah, they should, but those aren't the bonds that they're long. They're long double Bs. They're long triple Bs. They may be long some. In places that I have worked, they're really conservative and done a great job of staying way up the credit spectrum. But most places haven't, and they're in a difficult situation. So what that means is, I don't believe that people are trying to optimize returns in pensions at this point in time, Bilal. They are trying to make sure the pensions aren't compromised. And that means that they will be forced into being sellers of equities and buyers of bonds as things get worse. Because we're not in the recovery phase yet. And I think that is what the regulators and the central banks are really afraid of, is that it's not the short sellers or the hedge funds or whoever it is that is long an ETF that needs to get out. Those aren't the people that they're particularly concerned about. They can look after themselves. Maybe not the ETFs, but everybody else can. But the pension funds and the public pension schemes, they're already being forced to take action that they really don't want to do.
No, that's really interesting because there's such a big focus in markets on algo, high-frequency traders or hedge funds, the so-called glamorous end of the market. Yet what we're saying here is that there's another corner of the market, the supposedly sleepy, slow side of the market, pension funds, which actually could end up being the most important, the big driver of everything going forward. And not only that, but also it has some quite serious societal implications as well, which introduce all sorts of constraints or triggers, because you're talking about people's pensions here.
The thing that most concerns me, apart from the fact that we don't know nearly as much as we should do, the lack of scientific clarity on everything is really extraordinary. The testing results, obviously vaccine is something that we can't expect for a very long period of time. But really, the thing that really worries me more than anything else, this is going to sound very, very new world or new age rather, is the psychological effect on everybody. If you were walking along the road and you got hit by a car and you didn't see it and you're knocked over, and the next time you wake up in hospital and you've lost a leg, right? Something so grotesque, something awful. Well, everybody would say, well, that's obvious that you have got post-traumatic stress syndrome, right? I can't see why what has happened here, as people they're not under house arrest much, but is it not a quarter? The last time somebody said it, some journalists, it's probably untrue. I think it was a quarter of the world's population is in lockdown. Don't tell me that there aren't any psychological consequences of what has happened here.
It feels like investors and market participants and people in general want it to remain in the previous regime, which is that we've been in the post-GFC period where, in general, stocks have done pretty well over that period of time. Unemployment's been very low over that period of time. Inflation's been low. Whenever there's kind of a hiccup, the central banks can come in and support you. And so it feels like right now we're in the bargaining phase, and the bargaining is that, look, the policymakers have come in to support the market. There's a reflex in market to say that means everything will be fine. And so that's kind of the bargain that I think is going on at the moment, to say, look, we're still in this old regime. Policymakers have come in. They always help stabilize things and everything's going to be fine. Yet it does feel like we are entering a whole different regime. As you sort of said, that this is going to leave scars, psychological scars, even physical scars, I suppose.
And that will lead to behavioral changes, behavioral aspects in terms of the way that money and resources of all descriptions will be distributed. I don't want to be too millenarian about it, and let's face it, there's a load of macro whataboutery going on, and everybody wants to come up with the new view of the world. But there are all sorts of models that are currently out there. I mean, that have been out there for a very long time in physics, about how systems can shift equilibrium from one. In physics, you call it a phase or a state, from one state to another, very, very quickly, moving between a stable state A to a stable state B, but with a period of incredible instability in between. And that doesn't mean that it's chaotic. It just means that most systems do have more than one equilibrium, or more than one equilibria, I suppose you'd say. And I think that there is a danger here that if we are switching to new equilibria, that people are behaving in terms of investment behavior as though nothing has changed, they could make some very, very big mistakes. And can I give you an example of one? I hate to do that. It's not a trade idea. It's just more my perspective. I think a lot of people have called for some sort of move in inflation for a very long period of time. But the one thing we have had going against that has really been just the absolute outright supply of bonds relative to demand for them. And like I said, there's a reason why pension funds have been driving real yields lower and lower, as their demand for long-term rates, even at very low or even negative levels, is just not gone away. Is it possible that we are now starting to introduce so much more issuance because of what's going on here that might suddenly change that equilibrium? And to give you an example, a specific observation on that, I think, in fact, I'm sure it was John Maynard Keynes who was once asked about American industrial policy. And I can't remember when it was, 30s or 40s, I don't know. And he was talking about the period just before the First World War. And he said something I'll never forget. And the quote is that there was more money to be made selling the horse than there was buying the railway. And that's the way I like to think about things, is that, yeah, we all agree that probably equities get to a level at which they probably represent great future cash flow value, right? But what I'm saying is you're looking in the wrong place for the career trade. The career trade is selling the long bond, because how can we maintain these low levels of real yield. I know demographics are also forcing real yields to stay low, but it's just the supply. I really think there is some danger in the very long end of markets and fixed income becoming unhooked, unhinged. At the moment we're seeing these new programs coming in, and I understand that there's been a request for yield curve control, what they call yield curve control, which is control that the long end does not start to unhook itself from the rest of the yield curve. And for me, as soon as people start talking about it, that's when it's really dangerous.
Yeah, so I guess the thing many people come back to is the Japan story. How has Japan been able to run constant fiscal deficits, has gigantic government debt, yet its yields are incredibly low, and it's done this for a long, long time. So what makes you think that we won't just end up in a Japan scenario, just writ large?
Well, I have to say that it's still the most likely scenario. But remember, the thing that we've learned from recent events is just because something's the most likely scenario doesn't mean you should totally discount all other scenarios, right? So all I'm saying here is, number one, well, there are certain characteristics of the Japanese bond market. They may or may not be relevant, but here they are. Number one is it's incredibly largely owned by Japanese investors. And real yields have been negative, and deflation's happened there. So you may say that yields are very low in Japan from the perspective of being a UK citizen. But I'm telling you that when yields in Japan had a real yield of 3% in Japan, because deflation was 2 or maybe even 3, then they look tremendous value at 1%, if you know what I mean. So you have to be very careful looking at nominal yields, and you have to be very careful about looking at foreign ownership. And the US bond market has a lot of foreign ownership, so it's much more exposed to the needs and judgments of other people and looking at the dollar real returns. I have no idea what's going to go on with the dollar or anything. Who knows what's going on with currencies? But it just seems to me that real yields in the developed world and all over the world are so low and have been able to be here because of the lack of supply relative to demand, and demographics is pushing them to lower levels all the time. This thing, the dependency ratio. But really, I just think it's a slight danger here. What's some of the characteristics of what has happened in this COVID episode? Of the realization that really we do have incredibly overextended and complicated lines of supply. Would you be surprised if there was just a little bit more made in the UK or the US relative to China after this, or just a little bit? What about people's sensitivity to the prices of things? We haven't seen that change very much because people have been so price insensitive. Frankly, right now I probably pay £1 for an egg, but because I can't have them. Now, obviously, that's only temporary. But what I mean is, inflation is and always has been, according to certain people, a monetary characteristic. But now we may have let the genie out the bottle, and the genie in inflation is not inflation itself. The genie is inflation expectations.
Yeah, I mean, the argument I think about in favor of bonds selling off and inflation going up is, number one, I think that we are in a deglobalization phase now. So the Japan lost decade was in a globalization phase where, in essence, you had a massive explosion of production and everything, excess production. China came online. Japan offshored all its production, and there was just too much of everything. And now we've been deglobalizing since the Trumpian phase, you could say. And now the COVID, I think, accelerates that. And I think there's probably a bigger awareness today now that, while global supply chains may give you the lowest price and may be very efficient, they're fragile. They aren't very robust. And so you need to build in redundancies. And now I think companies are probably going to be more willing to say, look, I'll pay for that redundancy to get more robustness. And so as a result, the price goes up. It's another way of saying what you just said, where there'll be more made in your own country and people will be willing to pay for that. And I think many countries now will start to think, from a sort of geostrategic or geopolitical perspective to say, look, we need to make sure that we are self-sufficient in case something happens. Recently, I was speaking to a Russian analyst who was telling me how they think Russia is really well positioned in the COVID environment because it's been under sanctions for so many years now that during the sanction years, it actually built up its agricultural sector. So it's much more self-sufficient on the food side than before. And the country's kind of got used to being a pariah in the global system. And so today, Russia can kind of handle a lockdown because it's effectively been in lockdown already. And I think other countries will probably end up following that. And that just means prices go up. The other thing, I think, the contrast with Japan is that if you look at a lot of the fiscal policy and the monetary accommodation that Japan did over the last 20 or 30 years, a lot of it really didn't feed through to the real economy. A lot of it was just keeping zombie companies alive, bailing out the financial system. So it was just money being injected into the financial system and not spilling over into the real economy. And I think there's a difference with what we're seeing in the US and other European countries where they have fixed a lot of the financial system in some ways. And now they're introducing all sorts of measures now on the fiscal side, which directly inject cash into the real economy, which I think is more inflationary than what Japan did. And I think the other thing is that Japan, as a country, has always had excess savings. It runs a current account surplus, which in effect tells you the country has excess savings, which means that while the government borrows a lot, the private sector saves a massive amount. So on balance, you end up with domestic savers just funding the government. Whereas in the US and UK, both, the country's a net borrower to the rest of the world. There aren't enough savings to fund itself. And so it always needs foreigners to fund itself. And so it makes it much more prone to having higher inflation, which UK and US have had higher inflation than Eurozone and Japan. And it also, I think, makes it more prone to probably see bond yields go up as well. So for me, I think a lot of the ingredients are starting to come into place for that scenario.
Well, I wish I'd given that exposition of the explanation of why Japanese yields were lower about 20 years ago when I was selling JGBs and embarrassing myself every day like everybody else. But the only thing you can say as an investor is, do you have excess risk? Do you have not enough risk? Or do you have just the right amount of risk? I think it's the only thing you can be certain of now is whether you have excess risk. I don't think you can say that you have it not enough or even the right amount. That's not knowable. But you will recognize excess risk because you will see just unbelievable falls in your asset values. And how many people are prepared to hold on? See, the idea is people talk about these V-shaped recoveries. Well, that's fine. But, there are a lot more different alphabets in the world than just English. And some of the letters are some very strange shapes indeed, Vidal. So, it could be a Y with an L on the end. I don't know. It could look like a yen with two double lines, or even a pound sterling.
I mean, maybe we could end with a recommendation, not a trade recommendation, but something else where, like, if you were ruler of the world, or should I say, let's say you were the Fed chair and you also were the Treasury Secretary, so you had to control both the fiscal and monetary policy, what would you do right now?
I absolutely knew what I'd do, and it would be very unpopular, but it would make a lot of sense. This is what I'd do. I would assume that no matter what policy I pick, because I don't know about time frames, I'm likely to be wrong. If I'm likely to be wrong about something, I'd like it to go away as soon as possible as an error. And I don't believe that buying the full yield curve that's a very good way of keeping your error in place for a very long time. I personally think that they should have said, we are going to buy everything up to, let's say, a relatively short number, like 3 years, and that they should have made it very clear that there will be a lot of issuance, which they will